Today, folks, I want to discuss the performance of these three monthly paying Canadian dividend ETFs that yield between 4 and 6%, all of which have outperformed the S&P 500 this year on the back of this market turmoil, which is quite astonishing. And they offer a dividend growth rate between 6 and 8%. Of course, we're talking about VDY, XEI, and XDIV. And for all you new subscribers, we will talk about the global market ETF XEQT, and for that S&P 500 exposure, VFV. So if you're on a path to financial independence, if you damn well one day want to retire early, join me on that journey by simply hitting that subscribe button. And this video is brought to you by MOOMOO, which is currently offering an incredible sign-up bonus. If you put $100 in, you'll get 50 back. $5,000 will reward you 300. They currently offer 6% APY on idle funds and a 60-day commission-free trading period. And I believe they're becoming one of the best trading apps in Canada, but more on that in a moment. Now, we are witnessing one of the most pivotal earnings season that has been the defining factor to where these markets are going moving forward, thanks to the tariff war, which has brought down GDP. But even on the back of that, we've seen an incredible bolstering of earnings from the mega companies, even including the energy companies on the back of lower oil prices, which has helped really move the Canadian economy with recent earnings out of Canadian Natural Resources and Bridge. But we still have a lot of earnings coming up that will be another defining factor to what happens to these monthly paying ETFs, because most of them have major financial exposure. So next week, you can pay attention to things like TD. The following week, we have Bank of Nova Scotia and BMO, Royal Bank, Canadian Imperial Bank, and quite a few others that are still weighted in some of these ETFs. And as mentioned, we've even seen like telecom find a bottom. A lot of stocks that have already been hit super hard are in full recovery mode right now. And regardless about how you feel with these specific ETFs, they are still my favorite when I compare them to the insane amount of ETFs that Canada does have to offer. But let's dive down into this with first and foremost VDY. Now, VDY till I motherfriggin' die. It's one of my favorite sayings because this is one of the best performing Canadian dividend ETFs and keeps in line with the market performance of the broader Canadian economy, which you can see in tickers like VCE. Now, this recently hit an all-time high. Year to date has been absolutely crushing it, but the yield has slowly deteriorated away. I mean, you're not getting closer to that 5% we were once getting at the lows this year. We're now down closer to about 4%. And if we take a look, the current expense ratio is about 2%, which is higher than the other two we're going to look at. But the exposure also makes this not an end-all be-all solution to investing, in my opinion, because it is so concentrated in the biggest market cap companies. It's a market cap weighted ETF. So Royal Bank being this huge company in Canada, you know, it makes up 14% roughly of this whole ETF, meaning if you put 100,000 in this ETF, 14,000 is just going to be sitting in Royal Bank. And as mentioned, most of your exposure is in the Canadian banks, which if we take a look at the portfolio overview here, you can see financials make up 52%, energy at 30%, utilities at 5%. So you're mainly just in energy and financials. And with the earnings coming up on financials, that could offer a lot more volatility toward this portfolio or this ETF compared to the other ones that we're going to look at. So if we take a look at XEI, which is actually the highest yielding of these three, it does lackluster in the same kind of performance because it doesn't have the concentration. But I would say that's a benefit if you're somebody in retirement or you're more toward retirement age and you care more about diversification. I will say this one, however, is pushing back toward its all-time highs. They're all testing all-time highs here, which is quite astonishing. And this one still has the highest yield right now, I think, of somewhere between 5.5 to 5.8%. Expense ratio on this one is 0.2, so very similar to VDY in that sense. XDIV will have the lowest expense ratio, but if we take a look before we see the stocks, you can see financials and energy only make up 30% each of this total portfolio, so you are getting more exposure to the utilities, the communication sector, basic material. We did see the earnings out of TELUS, Bell. It looks like we're starting to get a recovery or a bottoming in the telecom space. You even get a bit of real estate in this portfolio. And if we take a look at the top holdings, you can see the highest weighted stock is Royal Bank, but it only makes up 5% of this ETF next to Toronto Dominion, Enbridge, TC Energy, Canadian Natural Resources. Great diversification and great exposure across the different sectors. And you could probably upperweight this one a bit more, being a bit more confident knowing that if, say, Royal Bank misses earnings, it's not going to bring down the total performance of this ETF. Now, let's just take a quick look at the last and final here being my favorite, XDIV. This one is only just starting to get back up, not really retesting the highs that it experienced from this year. But again, if you zoom out on the 1 year, the performance has still been quite astonishing. This one yielding right now about 4.5%. I think it's slightly higher than that of VDY and has a bit of a lower expense ratio at 0.1. So it is a great ETF overall in that sense, but it's concentrated and diverse at the same time. Firstly, you can see the holdings here with Sun Life, Enbridge, Toronto Dominion Bank, all making up about 9%, even with Manulife in here. And then you get some of the banks like Royal Bank, Fortis, which is a great utility company, Suncor, Pembina Pipeline. So this is actually like concentrating and almost diversifying at the same time. And if you take a look at the portfolio itself, you can see you're about 46% financials, 31% energy, 12% utility. So you're basically just taking the best performing stocks of each sector and kind of upper weighting them, but not market cap weighting them. So you're getting a concentration of a handful of stocks that are the better performers, but more or less equally weighting them, if that makes sense. I hope it does, but this is another really incredible ETF. Now you will notice that I am breaking all of this down through the MOOMOO app that I've recently been experimenting with, and they are starting to stick out as one of the leading competitors here in Canada. And one of the primary advantages for me as somebody that buys US stocks in US dollars, I have to convert the currency, and the banks charge a highly exuberated fee, along with Questrade and Wealthsimple charging 1.5%. And as a $10,000 example with MOOMOO, they only charge 0.09% plus $2, saving 278 USD. And when we talk about commission fees, MOOMOO does charge a fee of $1.99, whereas Questrade and Wealthsimple don't, but you get many other advantages, and that is an incredibly low fee to buy stocks. I mean, considering they have US level 2 data that is completely free, whereas Questrade charges $45 almost a month. Plus you have aftermarket trading as well. And if you're into options trading, this is a whole nother level of savings that you can dive into, that you can kind of review on this sheet here. But otherwise, they do offer these incredible sign-up bonuses right now against all these other platforms. Again, you deposit $100, you make an immediate 50%. You get $50 to invest. You do 5,000, you get 300, plus, you know, the 6% APY on idle funds, and the 60-day commission-free trading is something you can take advantage of today. And if you do want to support the channel, again, that link is in the description below. And I will say, I feel like I'm getting ripped off from my banks. They charge $10 per trade plus insane exchange rate fees, which is why a lot of Canadians, when they want that broader diversification, they look for Canadian counterparts to US stocks, like, let's say like the S&P 500's VOO. They would rather buy VFE. This is one of the most popular ETFs in Canada, which basically is the exact same ETF that represents the S&P 500, but it's converted the Canadian currency in the actual stock chart itself. So you're buying it and selling it in Canadian dollars already. The only downside to this is it is underperforming the US version of VOO right now, purely because the Canadian dollar has started to perform better again. And if the Canadian dollar starts to underperform, this will outperform VOO. Now, it's the same thing as you buying VOO, selling it, and then converting the currency over. Now, like I said, I'm somebody that likes to diversify my currencies. You don't have to, but I think this is a great solution to getting exposure to the US markets, considering there's a 0.08% management fee, and it's the exact same weightings of all the technology companies and financials and everything you get out of the 500 largest companies in the United States. Otherwise, I think most people, and something that we're starting to do, is get better diversification in our portfolios by globalizing. Now, this is something we've started to do because our portfolios have been scaling, and it's better to look for wealth preservation. So we've been slowly cost averaging into XEQT, which only slightly underperforms the S&P 500, but starts giving me exposure to all the world's economies, right? If we take a look, first and foremost, the fees are pretty low at 0.18%, but let me zoom my head out of the way, and you can see that the United States only makes up 43% of this ETF, Canada at 25%. Then you have Japan, United Kingdom, Switzerland, Germany, China, and all these other countries, which I think is a good thing to do for a lot of people that don't want to put time or effort into individual stocks. It really helps remove some of the personal risk and is an end-all be-all solution to cost average investing, in my opinion. But these are my 5 favorite ETFs, whether you're looking for that global diversification or you really just want some of that juicy monthly passive income. And I'd love to know what your favorite ETFs are, even if it's not these, down in that comment section below. But on that, I look forward to catching you in the next one.